What's up, guys? It is Sam, and I wanted to talk about the 4 things that happened with the options today on Monday, July 8th. Before I get into that, if this is your first time here, what's up? I'm Sam, and if you're returning, it's good to fucking see you. So, 4 things took place, but before I get into that, but it's just positions I opened and adding cash in there, so I'm not going to drag it out. But before I get into that, for those of you who are not aware of this, there's a couple exchanges. I think it's a Chicago Mercantile Exchange actually has options on the amount of rainfall. You're like, what the fuck is Sam talking about? Well, if you're a farmer and say you have a crop that needs a certain amount of rainfall, you could use these options as a way to hedge whether there was rainfall or whether there was not rainfall. I mean, I feel like most of the time it's probably not hedging, which that's an example of. I think often than not is probably used as a speculative instrument where maybe 20 to 40% of the market. I think this is and don't quote me on that, but I feel like those are similar numbers to the empirical research that I looked at. But they have options based upon the rainfall in an area, how much a rainfall, and think of that as the exercise price. Instead of having Apple be $200 a share and that be the exercise price, you have 2 inches of rain or something like that in the month of June. Some interesting things. Might get into those more often. If you want to see a video on that, let me know down below in the comments. I'll be happy to make one on them. I find options and how they can be utilized very interesting. I think combining options with blockchain in some type of capacity might be a very interesting to see how that can be applied to different things. All right. Now, with that, let's get into the portfolio. So today, as I mentioned, is 7/8, and I have a portfolio that I had started trading options. I started the portfolio probably a little bit over a year ago, and I was putting the money into SPXL, which is a leveraged ETF. What does that mean? It just means that they amplify beta. Beta represents the return to the market. So everything in finance likes to have some type of benchmark, and that benchmark is beta. So whatever beta returns, that is trying to have 3x beta. So this is a leverage return, meaning if the market returns 7%, then this fund is targeting 21% return. You're like, how do you do that? And that's through different derivative type instruments, whether that be options or more than likely something, some type of swap that's used to do something like this. So you base the option or the swap. Think swap is kind of like a 2-sided option, you can kind of think of it, but a swap is a series of like payments, but it's based on some type of benchmark, so it's always started at 0. Well, it's not always started at 0. Most of the time it's started at 0, but sometimes you can actually have a cash flow at the beginning of a contract, and using that to amplify the returns so that you can get higher returns. So if you want to just increase the beta in your portfolio, you could add in, say, 5 or 10%. By the way, none of this is financial advice. You should do your own fucking research. I'm not telling you what to do. Just you could add 5 to 10% of SPXL or something like that. You can find a leveraged QQQ, which is on the NASDAQ, an ETF on the NASDAQ. You could find something like that that's leveraged to increase the beta in your portfolio, to increase the return in your portfolio. Anyways, off topic. If you want to hear more about those, leave a comment down below and I'll be more than happy to talk about those. So yesterday, Sunday, I added $300 more to my portfolio. Also cut back on my spending, so my savings rate has gone up above 63%. I will have to do an update on that, but I added $300 more to the portfolio. So the total in aggregate that I have contributed to the portfolio is $4,287 plus the $300 that I contributed yesterday. So that brings the total amount of contributions to $4,587. The total portfolio value is $5,971.83. So I opened up 3 new positions. That was the first thing I was going to talk about. I believe because I was able to cut back on my spending, every month I'll probably be contributing about $300 more to the portfolio. As I move forward, I will keep you guys posted so that I have more funds to play with. Now, the first position I opened up was, these are all credit put spreads. One on Netflix, one on Amazon, and one on Tesla. So why do I choose these ones? I just like these. I've been playing around with them for a while. I like these companies. I think they're positioned very well. And the objective every week, if you're new, is to hit enough profit every week to be able to pull enough funds off the table to be able to purchase 1 share of Tesla stock. So I can keep trading with the same amount, but be able to take enough money off the table to be able to purchase 1 share of Tesla stock. This is going into week number 6. So in week, I think I'm going to do this going forward, so my portfolio is not super diversified, right? I have options and I have Tesla stock. And this has been the 6th week in a row of me taking $200 and change off the table to purchase Tesla stock. So next week, I will probably purchase something else, whether that's an index fund. More than likely, it will probably be some type of dividend stock. But I will keep you guys posted so that instead of that $230, taking that off the table, assuming that I made it, taking that $230 off the table and purchasing more of Tesla stock, what I will do is take that $230 off the table and purchase a dividend producing stock with hopefully some growth in it, or that's suppressed in value at the moment. But I will get more into that as the coming week progresses towards us. What I opened up on Netflix was the 365 to 360 put. So there's a $5 spread, which means that I could lose up to $500. Each contract was sold for $45, and I sold 2 contracts. So the most amount of profit I can make on this position is $90. The next position that I opened up was on Amazon. So Amazon has fucking giant swings in their price. So a lot of times I open these up in the 90%, 85 to 90% probability range. And when I did that, the current trading, what Amazon closed at was $1,950, $1,950, so just under $2,000. And I think it was like 87. The probability of it not being closing in the money was 87. So the range on that is actually $65 below that, which is incredible. Like, that's just insane. Like, think about how much the swing of that is, but it's a high price stock. So I have another credit put spread on there at $18.95 to $18.90. So the amount that I could potentially lose is $500 per contract times 2 contracts, or $1,000. Same thing with Netflix. And when I opened this, I received an average credit of $35 per contract. Remember, there's 2 contracts, so I can make $70 on this. It's already making money. It's already up $18, which just means I could purchase it back for $18 less and make the delta between what I sold it for and what I could purchase for now. That delta is $18. The last position that I opened up today actually has a wider spread. It's the same thing. It's a put credit spread on Tesla. So put credit spread, these are bullish type positions, or at least neutral. You want it to stay the same. It can come down, but if Tesla closed at around $230, So this is a 215 to 207.5, a $7.50 spread. So $750 I could lose times 2 contacts, right? $1,500. And the total, the average credit is $42, or the aggregate that I could profit on this is $82. So Tesla can actually come down by a substantial amount. Tesla can come down by $15 to 215, and then I still have the premium that I collected. So Tesla could come down all the way to 58 or whatever, and $13, 213.58, or something, or 14.58. What that means is that's the break-even price, and how you get that is right. $42 is how much I collected, but it's times 100 shares, so that's 42 cents per share. Each contract is based on 100 shares, 42 cents per share. So if you take the higher number, right, I said it was 215 to 207.5. So that top number, that's where if Tesla comes below there, we can start losing money. So to figure out what the break even is, we take 215 minus 42 cents per share. And that gives us our break even price. So if you take 215 minus 42 cents a share, that's where it's 14.58. Okay. So it could come all the way down to there, and that at that point I would start losing money. So it can come down more than $15 before I start losing money. Now, if you've been following along, that was $90, $70, and $84 from each one of those positions in terms of the maximum amount of profit that I can make. Now, what I neglected to mention earlier in this video was that not only do I want to have enough profit to be able to purchase one share of Tesla stock every week, but I want to have some type of margin on there, because I would like the percentage that I have to earn every week in profit to continue to decline, or at least stay flat. If you were to hold Tesla stock constant, the price, then if I keep adding to the portfolio value, the amount that I need to make every week would go down as this goes up and Tesla stock stay the same. So if Tesla stock goes up at the same rate that this is increasing, then the percentage of profit that I need to make represented by the total portfolio value is going to stay constant. If it goes up faster than the portfolio, in terms of Tesla stock going up faster than the portfolio is rising, then the amount of profit I need to make every single week is increasing, and that means additional risk if I held that profit objective the same. Anyways, if you guys have any questions about any of this stuff, let me know down below in the comments. I will continue developing this my thesis and strategy along with this. Keep posting the profit as well as the losses. Today I lost $70, but these are just paper losses, so it's not super important to me. I think more important is just waiting till the end of the week when these contracts close out. If you guys have any questions, as always, leave them down below in the comments. Appreciate you guys. If you find this video helpful in any way, or you find somebody else is talking about options or wants to know more about them, share this video with them. Don't forget to press that subscribe button too if you want to see the updates coming forward. Hopefully, with the direction Amazon's going, and it looks like some positive news is going to come out about Amazon Prime Day. So I don't remember when that is, but it looks like there seems to be some positive news going on around there, which would probably drive up the price of Amazon, which possibly, and we can take a look back at this video, you can see if I'm right or wrong, the price of Amazon will probably maybe continue to go up, and if that does, I could potentially close out of that position, take that profit off the table, which I think was $70. $70. So if I closed it out and made, $55 on that, I would probably open up another position. The total amount of profit between those three positions, if I held them till expiration and they all expired worthless, would be $244. So that only gives me a $14 margin if Tesla's trading at $230 a share. Anyways, appreciate you guys. If you have any questions, I'll leave them down below or reach out to me on Instagram. Peace.